Well, welcome to 2020. We hope that your year has started off great. My name's Ed Meisigland. I'm the managing partner here at Indiana Business Advisors. And today we're going to talk about, could you sell your business in 2020? This is an interesting topic that we typically plow into, regardless of what year it is. People want to talk about, can I sell my company? And so we're going to start today by talking about some of the X's and O's behind whether your company is saleable. Now, the X's and O's that I'm referring to may not necessarily all be financial. So let's start with the first question, though. The first question is, give me one second here. So the answer is always yes. You could sell your business in any climate. The challenge that any business owner bumps into is, do you understand the process of selling as well as the value you're selling? Because you want to be able to control the sale rather than the sale controls you. Unfortunately, a lot of times we run into business sellers that show up here, and it's a panic sale. And especially when it comes to health, the buyers recognize that there's weakness there, and unfortunately, take advantage of situations like that. So we always want the people that we're working with to be always be in a ready position to sell if you have an unsolicited offer, or you enter the marketplace under a controlled environment. So yeah, the answer is always yes. So the current environment, we for those of you that are for those of you in the that are business owners, we're seeing that credit is great. I mean, you can't top what's going on in the credit markets right now. And as you know, we the SBA is doing some great things. Those that are sourcing those deals are doing some great things, where we're seeing upwards of north of 90% financing. So a business owner is able to pull out nearly 90% of the purchase price. So that's a big thing. However, it's it comes with risk, and anytime there's that level of financing, there that tends to create a little bit of a challenge. Maybe not this year, but several years down the road. And then the second thing, multiples are flat right now, and I'm going to show you here. This is from Deal Stats. Deal Stats is a tracks privately held transactions, and I've used this for nearly 30 years. And what it does is, if you look at that, the legend across the bottom, it size matters, but the gray line is the larger business, and you can see the volatility there. As you move into the $5 to $10 million businesses, we still have some volatility, but we're not nearly as much. And then when you see the 0 to 5 million, it just stays consistent. But the takeaway from this slide is, I want you to see that there's not that varying amount of volatility that you might expect, like in a stock market. So it stays relatively consistent. Now, I have to make the caveat. I mean, this is for all businesses. It's not necessarily a industry specific. So within if you start slicing the pie, there may be obviously some volatility that different industries experience. But as generality, this is what you can expect. And I know I received a question on, what are market multiples of EBITDA. Well, here's your number. Okay, so currently the economy. When first thing, the good news is that when we don't have international disputes, we have a lot of capital spending. As we're seeing right now in the economy, the stock market just hit 29,000, or actually is just closed over 29,000. That's a big deal, because as the larger businesses continue to grow, the trickle down effects show up in small business. It's just a little bit of a lag. Next, the good and the bad. The good is that there's a record number of people employed. The bad is that there's competition for those employees. I can tell you that a lot of the companies that we're working with are fighting to keep people, or fighting to find people. So that creates a little bit of a challenge. The bad, as I was telling you in the last slide, when credit is that good and you have access to that kind of capital, why use your money if you can use the banks? There's no problem with that, right up into the part where you need to sell. And then, did that debt actually create value in the company? So corporate debts, especially excessive corporate debt, creates a challenge for us. And then the wild card, especially here in 2020, is who wins the election. What does it mean to the small business owner with if Trump wins, or whoever the Democratic contender is? I don't know. Personally, I think that there's challenges either way, and I think it's probably a lightning rod to stay clear of. But I do know that that's a big unknown, and I think you're seeing a lot of the business owners. I don't want to say just kind of sitting and waiting, and we saw it 4 years ago. That just kind of let's see what happens here. So that's, like I said, that is the big unknown. What I want you to take away from this, for those of you that are uh, that like cyclical analyses. If you look at this guy by the name of Rob Slee, he's kind of like the godfather of exit planning, and he's a deal guy, investment banker. Uh, Certainly, I mean, I've been following his work for 20 years, and he is a dynamic guy. He wrote a book called Private Capital Markets, and that's where this slides from. It holds true. So you can see, and let's just look at 2020. So based on this slide, we move into the next 3 years of deal recession. Okay, so and it's opportunities for business owners to work on their businesses. And then the next 3 years, or the next 5 years, you have the prime selling time, because you've worked on the business, and now you have the opportunity to capitalize on the seller's market. And then, like we've seen in the last 2 years, it's almost a recession. Well, from the the challenge that we experience with this is, when you look at that slide, we know that that number has kind of shifted. That, do I think 2020 anything's going to go wrong? No. 21, probably not. Depending on who is the president, we might have some challenges. But then, so 22 and 23, somewhere in there, we're bound to see a economic downturn. We just are. So with that, I think the position of business owners are, okay, well, what do I need to do? If I'm in the market to sell, is now the right time? Well, yes and no. I mean, yes, it's always a good time, good business to sell in any environment. The bad news is that if I'm the buyer, I'm looking at it saying, all right, I know there's an economic downturn. How do I get my investment back prior to that, so I can mitigate the risk of the acquisition? So that's something every business seller should be thinking about, is how to look at their business through the buyer's eyes. Okay, so reasons to sell in 2020. The first one, and I wrote these. I wrote these 10 and actually 11 reasons to sell in 2020. So the first one is that you buy into the supply and demand issue. So everybody's hearing, that there's going to be so many businesses on the market, and there's going to be a suppression of value because of the notion of supply and demand. I haven't seen it. I have a partner, he's 72, and he's kind of my proxy for what baby boomer business owners do. And he is still relevant in this practice. He's uh, still active, still competent. So in that case, why wouldn't I, or why wouldn't he stay in the business? So, and that's the same thing that we're seeing with others, but with other baby boomer business owners, that they're hanging in there because they're still relevant. God bless them for it. So if you buy the supply and demand, so again, it's back to panic. Well, I if you buy into that there's going to be a glut of businesses out there and it's going to suppress your value, then all right, then you probably need to get into the market. From my opinion, I'm not certain that Main Street moves at that speed, but that's just me. So I don't foresee the the glut of businesses. I do see that there likely will be a situation where um, people have waited too long or have extracted value out of their company, and now they have no choice but to sell, and it's it's selling an asset that hasn't been well maintained. So I do see some of that, but I don't see that we're going to have a supply chain issue. Number two, um, and I alluded to this with my partner, is that you're at that age that you want to pursue other things. I mean, believe it or not, um, you know, a business owner typically has his or her identity tied up in that business, and they don't travel, they don't play as much golf, they don't pursue charitable undertakings. They just don't do it, and so if if you're now starting to think more in terms of what else can I do besides that business, that might be you know the somebody tapping you on the shoulder that maybe you should think about this. So the business is up. You know, based on the composition of roughly, I don't know, 120 companies that we currently have in our portfolio. I mean, most of them are up. So, that's the good news. The it Yeah, so it is the good news. The good news that business is up, profitability is up. Now it's the question of, how is this an anomaly, or is it going to stay there? For me, I think it's going to stay, for certainly for the short term. But again, you just have to size up why is the business up, and then make the argument why it will continue. Number four, you have physical signs of deterioration. I know that's you don't, like I said earlier, you don't want to come into the sale process where health is forcing your sale, because unless you have a successor or someone that can offset the challenge of your health, we have a little bit of a problem, because again, the buyer recognizing that it's one thing to have age, it's another thing to have health problems. Age is age, and that's not necessarily a bad thing. But when we look at it from the standpoint of health, like for example, someone we worked with several years back, and they were gonna hold on to it, and then she showed up, and I'm I'm going into hospice, and I've got roughly 4 months to live. Well, obviously, we did all we could do, and we're going to sell the company, but the buyers, I mean, rightly so. What alternative in this case did she have? So that was a tough one for us. And so you never want to be in that position where someone's going to use that situation to their advantage. Now, can you not disclose that? Sure, but at some point it's going to come out. It always does. So again, health is a challenge. Sorry, number five, that you're getting solicitations from buyers. People are, you can be found on the internet, and through LinkedIn or through social media, and people are finding you, and they're saying, you know what, I like your business. Well, that should give you an indication that there's some interest in what you're doing. So whether or not you choose to act on it, that's up to you. But from my standpoint, I say, you know what, start a file. Each solicitation you get, either file it electronically or file it in your desk drawer, and keep those solicitation letters. And you should always be doing that, by the way, because at some point they may be your buyer. But it should be a trigger for you that this may be a situation where there's some attractiveness to your business that you may not know. Number 6, that your industry is in consolidation. So we've, over the 40 years we've been doing this, we've witnessed lots of industry consolidation. So if you're in it, and you see your industry consolidating, and especially when we see recessions coming, I mean, that's typically, let's band together mentality. Where we're rolling up entire industry, so economies of scale make the aggregate investment a better deal for everyone. So if your industry's ripe for consolidation, or you're starting to see it, or you're starting to read about it through trade magazines, that may be a decent indicator that it's time to start thinking about the sale process. Number 7, you're no longer interested in reinvesting in the company. This, to me, is kind of the for me, it's the lightning rod of, are you ready to sell your company? Because it does take capital reinvestment into the company to make it do what it historically has. And especially like in manufacturing, where you're band-aiding equipment, and full well that you should probably replace some equipment, and you don't do it. Well, the buyer comes in, and they will undoubtedly come in and do an equipment inspection as well as an appraisal. And if the equipment is not up to par, they're going to penalize you from a value standpoint. And I mean, you can't argue that. So from a reason to sell is, if you're taking chips off the table and just kind of milking it and hoping someone at the end of the day is going to buy it, that should be an indication for you to that it might be time to sell. Number 8, you find yourself thinking about what's next more than the business. And what's interesting is, there's a saying, it's about passion. So you go follow your time, not your passion. So you can say you're passionate about, pick it, charitable giving. But if your time is spent on the golf course, then that's a better indicator of where you want to spend your time. So same thing with the business. So if you find yourself not spending time in the business, and God bless you, if the thing can still operate profitably without you, that's a real good situation for you. But if you're the owner operator and you're there day in and day out, and you find yourself thinking about what's next rather than the business, then that's probably an indication that it's time to go, or at least time to start evaluating. Number 9, you're adverse to risk. So certainly as a business owner gets older, the business owner finds themselves less risk adverse, and rightfully so. I mean, they've got their retirement to think of. So if the more risk adverse you are and more retirement risk adverse you are, then that's probably a trigger for you to say, yeah, this might be, I need to start thinking about this. And then lastly, you need to know that the buyer wants to have favorable access to capital in order to get maximum value. So if like in today's environment, if you look at the business as we were talking about, or the lending as we were talking about, the rates are so low that it's amplifying the amount of purchase price. It's not necessarily amplifying the value, or it's increasing the value, but it sure as heck is making it much easier for a seller to say yes, because they're getting 90+% of their purchase price in on the downstroke. So virtually all the risk is on the side of the buyer. Now, rates change, rates increase. Guess where it's coming from? Well, we're going to do a couple different things. One, there's only unless your earnings are such that it warrants it, and we have a webinar on how to calculate your earnings a couple months back, so see that one. But when we have capital and the cost of capital has increased, there's nowhere else to go but to attack the debt service. So it's going to cost more for debt, which is going to suppress the value. That's something you don't want. As well as if credit is such that they're not willing to lend 90%, they're only willing to earn or lend 50%. Well, now we start moving into seller financing. Now we start moving into other vehicles to get the deal done. So that's the challenge. Is you need to look at your business through the buyer's eyes, and the buyer's capital is such that you want them to have favorable rates because it will garner you the most cash. And then the bonus, you want to control the sale. The funny thing is, every business owner that we work with, they got into business. The financial benefit is one thing, but I'd say 95% of the reason that people either started the business or bought the business is because they wanted to control the destiny. And it's the same thing on the outgoing too. If you want to control, if you want to control the sale, then you control the sale. All right, so reasons not to sell in 2020. Your financial reporting's in disarray, and it was edited out, but if your financial reporting is a train wreck. For example, if the buyer can't track let's just take it from start to finish. You issue a purchase, or someone buys something from you. You issue an invoice. That invoice gets paid. That paid invoice gets deposited. That deposit goes into your financial statement. The financial statement ties to the tax return. If a buyer or a broker or whomever can't track all of that, and where the discretionary and non-recurring expenses are, then we've got a problem. So when I say we have a problem, it's hard to sell a buyer on financials that you can't rely on. So what's the buyer going to do? Obviously, they're going to either discount the purchase price, or they're going to mitigate their risk some way. And so you don't want that. Number two, you have sufficient capital to withstand the recession. Okay, like I was just showing you, there's a 3-year window where either you have value enhancement, and when I say value enhancement, that can be through picking off competitors, picking up businesses that were not as prepared as you. So there's nothing wrong with that strategy, as so long as you understand what you're getting into. So as you look at the landscape of your industry and your business, if you have capital, you're not sitting on a bunch of debt that you have to retire, and you have access to capital. I can guarantee you there'll be lots of opportunities for you to take advantage of. Number three, if you have customer concentration issues, again, this is a detractor from value. One of the challenges that any business owner faces is if you're looking at a 10 to 20% concentration issue. And when I say concentration, that one client represents 10 to 20% of the revenue. That's a tough one, because if I'm the buyer, what's the likelihood that I'm going to be able to have that same relationship that you are, Mr. Seller? I was recently talking to a client yesterday, and in her case, she had she had a customer concentration issue where it was 20% of her revenue, but 40% of her profit. And they got into a situation, and long story short is that they lost that customer. Obviously you can see where that the value just evaporated with that one customer. So the same thing with the buyer. When a buyer recognizes and sees that there's that potential, how do I mitigate that risk? Well, I mitigate it through either reduction in purchase price or reduction of structure. That's how I do it. So if you have a customer concentration issue, you need to work on it. If you need some tips on how to do that, I'll be happy to share some of the things that we've seen that have worked well. All right, so industry forecasts. Again, I was just referring to it on the opposite side of on why you should sell. If you have consolidation going, I mean, you can be a consolidator. It's little fish eat the smaller, or the big fish eat the smaller fish, and it just is. It's kind of like a what's that thing called, a nesting doll. The little, the just the bigger one eats the smaller one, and it just keeps going. So if you're in a position, you can be the consolidator and build yourself as a target for the next bigger company. And like I said, we've been doing it long enough that we've had the opportunity to see that acquisition landscape where a small company serves as a platform, and then they just start bolting on. And you probably heard the term bolt-on acquisitions. That's what that means. Private equity groups get into it where there's opportunities, especially in this current environment where they're sitting on a bunch of cash that has not been deployed yet. Number 5, your spouse. I was strongly encouraged not to include this, but it's true. You know what? You shouldn't sell. You need to talk to your spouse. Your spouse. In fact, I've hired a couple brokers that we sold their companies for, and one in particular, the wife called up on our ad and said, "Look, I got to get him out of the house," and so we hired him. So the long story short is, again, you look at what does your life look like after business, and if you're used to spending 10 hours at the office, and all of a sudden you and your spouse are going to be nose to nose, day in and day out, that might be a kind of a crimp in each other's style. So you may want to examine whether it's the right time for you relationally. Difficulty attracting and retaining employees. This one's a hard one. I mean, that we're all fighting that same battle. When employment is the way it is and the economy is the way it is, everyone's having a battle. But if you are constantly experiencing attrition, like serious attrition, like you're turning over your people, I think the benchmark was like 40% of your people, you have a pretty good problem. Because again, if I'm a buyer, I come in, I look, how am I going to mitigate that risk? I mean, I'm at the will of attracting the same people that you're working with. Number 7, you don't want to. Again, it's back to the control issue. You may not want to sell, and don't. That's the beauty of you being you, that you don't have to do this, and you can control whether or not you want to sell or not sell. That, again, don't discount that. You've risked your financial wherewithal on this business. Do what you want to do, and don't and be done with it. Just make an informed decision one way or the other. Okay. What do you do when you don't know what to do? All right. First thing, be ready, regardless. I stomp around and say, you need business valuations and so on and so forth. And I do believe that. I think valuations are an integral component to this practice and any successful transaction. But what's more important is that the seller, the business owner understands where value is created in their business and where it is detracted. That's the key ingredient to a successful sale. Is you have to understand just how all of this works. The process is one thing, but understanding how you are able to, or how a buyer looks at you and looks at you through the eyes of risk. And I think, to me, that is how you prepare a company for sale. Not necessarily the value is what the value is. I mean, the market will tell you what the value is. Um, and there's nothing, I don't want to say there's nothing I can do, but from a business valuation standpoint, we can interpret that what this is what buyers typically pay for companies like that, and we have the empirical data to support it. But at the same time, um, you just need to understand how a buyer is going to look at the business, so you can, anticipate. Because if we can anticipate together, then it makes the whole sale process easy. Or easier. Okay, take out a piece of scratch paper and remember that acquisition list I was telling you about. You get somebody indicating they have an interest in buying your company, or they have buyers, or whoever soliciting you, make that file, put this right with it. Who's your deal accountant? Okay, that's the first thing. Hopefully you have a good accountant, and if you don't, let me know. I'll get you a list of accountants that we work with. Attorney, you know, I was speaking at an event at Butler earlier this week, and this was brought up. What's a good attorney? Well, I can tell you that an attorney, in this case, it was Bob's attorney that handled so and so's divorce, is not a good transaction attorney. So you need someone that's versed in doing business deals. So, and again, same thing. If you don't have an attorney, let me know. I'll get you 5 or 6 names that of all different price points. So you can begin compiling that list. Next, financial planner. If you don't have one, I mean, you do need to figure out what you're going to do with the proceeds from the sale of your company. You need to do that. And in fact, you don't have to wait on this one. There's two things that you need. One, you probably need an idea of what the value of your company is in order for the financial planner to work their magic and tell you, what is the second third, or the third of your life look like, and how that plays out. So again, financial planner, banker. You, yeah, especially if you're carrying debt, who is your banker? And because that banker that you've had that long-term relationship with might be the buyer's banker, so that's why we need that. And then lastly, if you're going to use a broker or an investment banker for your deal, um, you know, start making a short list. You can. And I'm always asked, how do you identify a good broker? Well, the first thing you do is use the internet. The internet's stalking you. Why not stalk a few people out there out on LinkedIn and see who's active, who's doing deals. Most investment banks, especially if you're in an industry, I don't say that's necessarily consolidating, but you'll see, if there's industry specialists, you'll see that. You'll see people that are promoting the deals that they're done. I mean, I know that we just put out, our recent post on passing 2,100 deals done. I mean, people that are doing deals are proud of the deals that they do. But you just need to compile a list of those deal people in your market that, just the short list, and just keep them. So take that list, put it in your file. If this is real important. You at some point, especially if you're approaching an exit, those that love you, you need to have that conversation. That what does my life look like after? What does our life look like after this? And if you want to run your business, then run your business, and oh my gosh, don't think a thing about not selling. If you want to run that business into the ground and they wheel you out, God bless you for it. That's okay. But those that love you need to know what you intend to do, so it's not a surprise. So the planning of an exit is important. And then, like I said, you just need to think about what you're going to do afterwards. Um, and again, it's funny. I was reading. I've seen a few things on how to half retire, and that's an interesting concept. Can you dip your toe into being partially retired? I don't know. I mean, I think it depends on who is on your bench to take your role, and can you keep the earning stream flowing that will facilitate you not being there on a regular basis. But again, those are that's a situation we can explore. I have some various tools that we'll talk about in a minute that can help you self-identify if that's a situation for you. Okay, speaking of these tools, first thing, um, Prescore. Prescore is a self-assessment. This is complimentary. You're more than welcome to go do this. It helps to determine emotionally whether or not you're ready to sell. What does your life look like? And it's like I said, you'll get a 30-page report. It'll kind of assess where you're at and what you might be thinking about. The second thing is the value builder system. I don't know if you've heard of it. You're more than welcome to take that self-assessment. We've found it's an interesting conversation with the business owners that we work with about it, because it identifies 8 drivers of value. Remember I was talking to you earlier about the risks associated with looking at your business through a buyer's eyes. That's what this thing does. It quantifies that. I serve on their international board, and the interesting thing is, I mean, they've got 50,000 data points. I mean, how many 50,000 businesses have gone through this process. So they can, through algorithmically, they can determine, what are the drivers of your particular business, because chances are they've seen a business like yours. So that's an interesting self-assessment. Again, complimentary. Happy to do it. It's a good way to begin um, having those conversations. Also, as it relates to this, it'll also some of the things that we do. We can toggle or change the scores of the different value drivers to determine what increases or decreases the value of the company. So if you say, look, I need, $4 million. All right, you're at 2.5 million now. All right, so let's see where based on your answers, where do you fit in? If we can move this ratchet, or owner dependence, if we move this lever, how many hundreds of thousands of dollars can we add by figuring out how to help you diversify your role in the company? So that's an interesting tool that, like I said, we're happy to share with you. Lastly, these are the questions that came in. So how do I find a good fit to sell to? That's probably a topic for an entire webinar, but I'll give you kind of a high level. First things first, based on size, typically a company that is going to acquire you. So let's look at 3 buckets of buyers. You have individual buyers, strategic buyers, and private equity groups. So individual buyers are basically buying themselves a job. So what does that buyer need to look like talent wise, in order to replace you? If we're looking at it from a strategic or private equity standpoint, that company typically needs to be at least 3 to 5 times larger than you in order for it to make economic sense. So that's like super high level overview of that. You certainly reach out to me. I'm happy to dial a little bit further into it if you wish. So how to prepare to sell and what multiple of EBITDA should I expect? So a few slides back, well, actually about the third slide, you saw kind of the multiples. It depends on the industry that you're in. I've seen lots of different multiples based on just where that industry is in its life cycle. So again, happy to help. Just reach back out, but it just depends on where you're at. So the pros and cons of selling a business with or without real estate. So the pros and cons. So the pros, obviously, it's a more leverageable asset. It facilitates lending from the standpoint of you can then blend your business acquisition plus the real estate mortgage into one loan that increases the amortization and lowers the the monthly payment. The other thing is that it's back to risk. So if I buy the business, what's the worst? There's a floor of what can happen to me. I have the real estate. I have the equipment that I can auction off. So the real estate, that's the pros. The cons is it depends on what the condition of the real estate. It's like any other asset. Is the in this case is the juice worth the squeeze? What am I going to have to do in order to upkeep this piece of real estate? If your business is run out of a home, and I ran into this week. So if you're running your business out of your home and you want to sell the whole package, well, in this case, it was like, okay, well, no one wants to buy your home. They want to buy your business, but we're probably going to have to relocate it. So the con then is, okay, well, now you have a piece of real estate that you're going to have to sell, and that may or may not be a challenge. But moving forward, if you're not paying yourself any rent because it's being run from your house, somebody's going to have to pay rent, and that's going to reduce the gross cash flow that you have, and it's then going to reduce the value of your company because it's now into another, in a lease scenario. For most buyers, I can tell, it's real estate is a real good thing. Is contraction. Customer concentration is always an issue. Yeah, customer concentration is always an issue. There's certainly ways around it. Typically, the biggest thing that we see is what's called earnouts, or another way to look at it is if-then financing. So if X, Y, and Z happen, I am willing to pay you that, but that has to happen. And so it's a way to mitigate that risk. The challenge with customer concentrations is that we get into, if you can't have earnouts with SBA financing, and and that's just the way it is. There's nothing I can do about it. So anticipate that there'll be either a financial discount or a structured discount in order to do that. How to sell your business if it isn't profitable? Okay, well, if it isn't profitable, the funny thing is, and this is a crazy thing that we always see, is that I've had business owners come in, drop their financials off, and I examine them, and they're showing a negative on their tax return. And so that implies that it's a negative, that there's something wrong with the business. Well, what the guy, a few lines up in officer's compensation, the guy was taking $350,000 for, and in this case, it was absentee owned. So he's taking 350 grand. He's got depreciation and amortization. So the company was really closer to 350,000 in positive cash flow. The tax return was adjusted to minimize the tax, as it should. So if your business isn't profitable, I guess the first thing I would say is make sure that you're sure that you're not profitable. If it really is not profitable, I mean, you're looking at basically the asset value of your company. I mean, that's part of, it may or may not be the issue. I guess the underlying issue is, why are you not profitable? Is it the industry? Is it you? Is it operating expenses? Is it, you're no longer paying attention to the company? There's a variety of things that it can be. So first thing is identify whether or not you're truly unprofitable. Second thing is determine why that is. And third, can you offset that? Is that a saleable asset with the story that you're telling in step two? I don't know. But like I said, the first things first is, if it's truly that unprofitable, then you're probably looking at a liquidation value kind of situation. And if you need help with that, I mean, I can put you in touch with people that can help you. And I know, and you're always conflicted on, well, I've got employees. Yeah, I get it. And I do. But again, it's one of those things that we need to probably sit down and identify the pros and cons, and why you would or wouldn't just go ahead and engage somebody that can ease the bleeding, so to speak. All right, I don't see any other questions. All right, so again, if you have any questions, here's all my contact information. Chelsea, man in the chat box, is telling me that this will get sent out. So if you had to leave for whatever reason, you'll get a copy of this link that you can replay it. If we can help, certainly let me know. We've been in business for nearly 40 years. We have an open shop. We've always been this way. We'll let you know if we have to turn on the meter, but we always believe that informed business owners make better clients, and that's what we're about. And then lastly, if you want to do any of this value builder self-assessments, go to valuebuilders.us. There are things all over that page that you can click and then take the assessment, and we're happy to have an exploratory conversation on how you might be able to use that. All right, so that's what I have. So I hope you enjoyed our time. Like I said, if there's anything we can do, let us know, and we'll see you next month on, I believe, the third Thursday of each month we have set up. So we'll get a notice of what the next topic is. If you have something that you want us to talk about, happy to do that too. So thanks so much for your time. And again, we'll see you next month.